Hello, everyone. I'm Charles Osaka Adara. I'm the Director of Tax at Fincra, and this is Fincra Answers.
The clients paid my 10 million naira invoice, but only 9.5 million landed. They said the missing 500k is withholding tax. I have never agreed to that before. I don't know what that is. Walk me through where my money actually went and what I have to do to ever see the money again.
So I think this is a very typical case transacting in most countries. Now, withholding tax is simply an advance payment of tax on a transaction. And what that means is for any transaction that gives rise to an income, and the income would be subject to tax in that country, most likely withholding tax would apply. In this case, what has most likely happened is your transacting partner has withheld a certain amount, which is a mandatory requirement, and has paid it on your behalf to the government of the country in which the business was consummated, right? And now what you simply have to do is reach out to the tax authority in that region and provide proof of this deduction, and you should be able to claim that deduction as a credit.
Interesting. So it's the government that will be paying you back the money. Or
Basically, you can utilize it as a credit against any taxes you might have to pay in that country, or as a credit against taxes you have to pay in your home country.
my business pays US companies for cloud and software every month. Now, my accountant says I should have been charging myself VAT on those payments that I have to make.
You should have been charging yourself
VAT.
VAT. That's not how it works, sir. First things to, we need to separate it, right? VAT is actually a tax that is being borne by a consumer. And so what that means is for you to even discuss VAT, you need to consume the service, right? Now, if you have consumed service from a service provider that is in a region where they are required to charge you VAT and they haven't, depending on the region, right, you may have a self-charge obligation. Now, how this works is you basically have to account for the VAT as though you were charged for it and then remit that to the government. I presume that's how that situation has come to be.
My company ends in Nigeria, Ghana, and the UK. And all three tax offices in these three different countries want a cut of the same profit that I already make. What actually happens to the money, and how do businesses keep from paying taxes three times in three different countries?
That's a very interesting question. So I think that edges on a very common term that you might have heard on the streets where they say things about double taxation and stuff like that. Now, this is common where you have dealings in multi regions or multi countries and you earn revenue. Most governments have become aware of this, and how they've tried to solve this is to come under different agreements, bilateral agreements, and multi country agreements that allows that once a country has exercised taxing rights on a portion of income, then no matter whether income is transferred to or whether income is reported, the other country would not exercise taxing right. So this basically means that it helps that once a country has taxed a certain amount of your profits to a large extent, you can submit that as proof for you not to be taxed in another region.
My Nigerian company pays a management fee to my own holding company, and the tax office says my price, that's the price I'm paying to that holding company, is wrong. It is my company. Please explain how my own price can be wrong and what am I supposed to do about it?
Okay. It's also a very relatable concept, right? And now this touches on the concept of transfer pricing. Now, what we're simply saying here is the tax authority is trying to ensure that whatever fee or whatever value you ascribe to a transaction between two entities that are related in any way, be it by direct shareholdings or by direct control being that one entity can control the decisions in another entity. Indirect control meaning that one entity can also influence the decisions, maybe not directly, but through another entity. Or maybe you have what is known as common control, where you have the individuals who control entity A also controlling entity B. Now, what the tax authority in most regions would do is to ensure that the way value is transacted amongst these entities is in such a way it would have been if it was done between third parties. So in simple terms, the tax authority would always want your transactions to be valued in the same way it would have been if you had transacted with a third party, a person who is not related to you in any way, maybe by common control or by direct control. And that is why they may say your fee is not adequately quoted when they benchmark against what a third party, that's a non-related individual or entity, would have charged you for that transaction.
Okay, so now this is bonus question. There are two extra bonus questions. Now, question one from the bonus one is in January 2026, Nigeria deleted the entire tax rulebook and started over. Now, if you run a small business, you may now legally owe zero income tax. Is it really zero income tax, and what is the catch?
So that's a very interesting question as well. And it's one topic I speak on most times. Yes, Nigeria's new tax book it appears quite favorable to small businesses, right? And this is because what the government has done essentially is to put a ceiling to what they can tax, right? And in simple terms, they've said if you do not earn up to, or if you do not make sales up to 100 million in a particular year, then whatever amount you've made as sales and whatever profit that comes from that year is yours to take fully. So yes, looking at the current tax landscape in Nigeria, small business owners defined as companies that earn less than 100 million can take all of the profits at zero tax.
Question number two from the bonus question. And this is the last question of the day. The question is you bought crypto at 2 million naira, sold it at 12 million naira, and the money never touched the Nigerian bank at all. The Nigerian new law says the government wants its cuts from that sale anyway. How would they even know?
Oh, well, so now you've touched on administration, right? And when it comes to administration in Nigeria, it's an angle where every party, the taxpayer, the administrators themselves, we're always curious to see how it would be executed. It's one thing to have something written in the law. It's another thing to have a practical guideline as to how that would be executed. I mean, a lot of speculations have gone around the government mandating financial institutions to submit records of transactions. A few speculations are around the government digital fiscalization approach to ensuring that financial institutions report every transaction and mirror every transaction to the tax authority. So there are many ways people have speculated, but at the moment, there are no clear-cut guidelines as to how they intend to administer this. But looking at the letters of the law, yes, the government has now made it part of their rights to earn tax from such a transaction.
So, but how do you know?
Like I said, different approaches. I mean, it could be from the digitalization of tax compliance for fintechs and financial institutions. In essence, this forces financial institutions to disclose every single transaction, right, that they process for any customer, be it a local or a foreign transaction. Right, so this could be one of the approach they could use. It's still speculation at the moment. We're all waiting to see how the government truly approaches that matter.
Thank you very much. That considered the question.
Thank you very much for listening to Fincra Answers. If you have any questions, please put them in the comment right below and we'll be in touch.